This video is to replace our classroom instruction uh, for the classroom date of April the 5th. And it's going to include the instruction for the first part of Chapter 1, when that'd be the first part of our Chapter 1 workbook also. So let's go on and take a look at the game plan for the next couple of weeks before we go on to Chapter 1, because some things are changing. So let's take a look. Okay, this is the upcoming schedule for the next up through April the 24th. Now, what I'm going to be using is I'm going to be using one of those electronic pencils that works on a separate scratch pad, kind of like when you sign your signature for a credit card. Now, I will tell you, and you probably already know this, or you're going to figure it out pretty quick. I'm not really adept at using this because I don't use this method that much, but because of the timing of this video, I need to use it. But sometimes there will be some challenge in me writing items that are recognizable, and I'll try to work with you on understanding what those items are. So let's go ahead and take a look at our upcoming schedule through April the 24th. Okay, the class that we are canceling is of April the 5th. Again, though, the assignments stay where you need to read Chapter 21, complete the Chapter 21 quiz, and do your homework problems that are listed in Blackboard. And the chapter homework and quiz are due on April the 15th. Now, we're going to hold a regular class on April the 10th, which will be the obviously not this Thursday, but the following Tuesday. And then the exam, or I'm sorry, before we go on to the exam, then after April the 10th, let's skip down here and look at April the 12th. What we're going to do is we're going to start with reviewing Chapter 24 in the Chapter 24 workbook. And then we will take our exam, instead of on April the 12th, we'll take it on April the 17th. That will give you some more time to study, and also it will coordinate with the due date in terms of our Chapter 21 homework being due on April the 15th. So the midterm is going to be on April the 17th, and again it will be over Chapters 18, 20, and 21. Okay, the other area that I need to emphasize is that I will have a practice exam issued, and it should be available no later than the evening of April the 6th, which is this coming Friday. Okay, so that's essentially our schedule through the end of April the 24th. I'll also be publishing that change of schedule as an announcement, but I want to make it also in this video. So let's go on now and take a look at the content that we're going to be covering in Chapter 21. You're going to see here lots of information, and everything is going to be centered around this concept we call incremental analysis. An incremental analysis means that in many cases, when we're going to make a management decision in a company based upon its costs, we have to understand the behavior of the revenues and the cost, and we do that through an incremental analysis. And we'll go through these different objectives as we go through the workbook. We're going to understand what incremental cost, what they mean. Also, we need to be able to identify what incremental costs are, because not every cost is an incremental cost. We also are going to then help practice and gain the ability to perform incremental analyses Also then, using incremental costs, we're going to be able to analyze decisions as to whether to accept or reject what we call special orders. So we're going to look at that particular technique. Also, we're going to use incremental contribution margin to analyze decisions whether to accept or reject orders. So these two items are related. They end up with the same decision, they're just done a little bit differently. Also, we're going to use incremental costs again to analyze decisions, and this should be uh, in making, let me put the I in there, in making or buying type of decisions. So in some cases, we have to decide, should we make that product in-house or should we buy it from somebody else? And we will use incremental cost to analyze those type of decisions. Also, we're going to be using incremental cost to analyze decisions in selling, scrapping, and rebuilding. We're also going to be able to understand how to perform what we call joint product cost allocation. And what that means is that is a process where certain items are made as derivatives from a common item. Also, we'll use incremental cost to analyze joint product decisions and incremental costs to also analyze what we call production constraints. So those are the major objectives that we're going to be uh, working within. And again, I apologize for, I will say the word my penmanship, utilizing this electronic pen. Now, when we're talking about incremental analysis, the first thing we have to understand is what is a relevant cost and what is a relevant benefit. And what we're going to do here is we're going to go over these definitions. Okay, first of all, relevant costs and benefits are those future costs and benefits that differ, again, very important, that differ between two or more competing alternatives. In other words, when you have a decision to make, we have to consider what are the future costs and benefits of that decision, especially where those decisions differ between at least two competing alternatives or even more competing alternatives. In other words, based upon our incremental analysis of several different decisions, which is the best decision under the circumstances? And what is relevant to us is where those benefits and costs differ. Now, if you don't quite understand that, it'll become apparent, I think, as we actually do some examples. Okay, I'm sorry I had that glitch in the recording. That was obviously my fault. It wasn't a technical issue, it was the operator issue. Now, let me go on and point out a couple of other items that I need to get a couple things aligned here. Okay, so let me go on and talk about some of the subsets of what we mean by when we mean relevant costs. Okay, relevant costs are future. Okay, very important. They're future cash flows, and that includes inflows and outflows. Typically, outflows are expenses and cost. Inflows are typically through revenue. There can be other items, but right now we'll just worry about the word revenue, or we'll worry about the term revenues. Also, relevant costs are also incremental cost and benefits, meaning that they are composed of changes in costs or benefits that occur as a direct result of an alternative being taken. So an incremental cost or benefit is a change, plus or minus, in cost or benefits that will occur when I take a particular alternative. In other words, when I make that decision, I am going to incur those incremental costs and benefits. If I make another decision, I'm still going to incur incremental costs and benefits, but they're going to be of that second decision. Okay, now let's go ahead and look at the next item, and that's a thing we call a type of incremental cost we call an avoidable cost. And what this is this is a cost that can be avoided. In other words, if we pick an alternative, we're not going to have to make an outlay. In other words, that cost can actually be avoided. So it's a cost that can be avoided based upon the selection of one alternative over another. So if under one alternative I have to pay $100 a month for something, and the other alternative I don't have to pay for it, I can say that $100 is an avoidable cost. Okay, the next item after that is opportunity costs. Now these are kind of interesting because they're actually not truly involved as cash flows. Basically, an opportunity cost is a benefit. Okay, so in other words, a benefit, and that's typically some form of cash inflow that will be sacrificed because of the choice of one alternative over another. Now, students many times have a problem. Let me get my work back here. Okay, many times students will have a problem trying to understand what that really means, opportunity costs. If you can look at it this way, assume that you have a car, an old Camaro, and that old Camaro, somebody comes by and says, I'm willing to pay $10,000 for that car. Do you want to sell it to me? Now you have two alternatives when you think about it. You can accept no cash flow under alternative one and keep your car. Number two, you can accept a $10,000 benefit basically in that alternative in terms of the cash flow. So what you're really doing is if you choose the alternative not to sell the car, you are incurring an opportunity cost because you are foregoing the benefit of the $10,000. You're sacrificing that benefit because you chose the alternative of not selling that car. And it's something that, again, when a company has to make decisions amongst alternatives as which is the best alternative, they also have to consider the fact, are there any opportunity costs involved in this process? Now again, this next slide, this first slide up top here, is simply a reiteration of the first slide definition of relevant costs. And again, relevant costs and benefits are those future costs and benefits that differ between two or more competing alternatives. In other words, when we are examining alternatives, the only costs that are truly relevant to our that are truly important to our decision process are our relevant costs and benefits. Any other types in cost and benefits that are not relevant are not important to the decision process. And we'll see how that works in a few minutes. Now, we can also classify or identify certain costs that occur that are not relevant costs, or that are never relevant costs. So first of all, the concept of what we call a sunk cost. You're going to hear this concept a couple of times in the Chapter 21 presentation. This represents costs that have been previously incurred. We've already spent the money on them, and they cannot be changed by any decision amongst the alternatives. So what it's saying is that the money that we have spent is gone. It cannot be changed no matter what selection we're going to pick or what alternative we're going to pick. That money is simply gone. It's money basically spent. It's down the, I wouldn't say down the drain necessarily, but it's money that we can no longer consider in part of our incremental decision process. Then we go on to our next item, and that is committed costs. Committed costs are future costs, in other words, future inflows and outflows that were previously committed based upon some prior decision that were previously committed. We can't get out of them. So what we're saying is they're future costs that were previously committed, and these costs, even though they're future costs, they cannot be avoided. In other words, those costs are still going to be incurred. We can't do anything about those costs, no matter what decision is actually taken. So that's the definition of a committed cost. And a committed cost, just as a sunk cost, is a non-relevant cost. In other words, it's not going to be a cost that enters into incremental decision analysis. Okay, let's go on to the last definition, and that is non-cash flows. And that means any items that basically do not involve cash flow, are also non-relevant costs. So any items that are non-cash flow, such as depreciation or amortization and so forth, are not relevant to the incremental decision process. Okay, now with that information, and there is a lot of definition, so you may want to study that information, these last couple of slides, or what you've entered in your workbook. Let's go on and take a look at the next slide. And this is an exercise in creating identifying relevant costs as part of the decision-making process. Now, let's go ahead and at least read the first paragraph here of this decision-making process. John desires to spend his spring break, which is going to amount to 7 days, in Fort Lauderdale, Florida. And John can either drive his own car to Florida or take a flight to Florida and rent a car for 7 days. So now John is faced with two alternatives. Okay, John's already made the decision to spend his spring break in Florida, so he has two alternatives, because he is going to Florida one way or the other. He can either fly, and again, let me set my writing instrument up here. He can either fly or he can drive. So now we have two alternatives. That's D-R-I-V-E. Now that we've identified the alternatives, that's our step number one. Step number two then is we need to collect all the data that is involved in that could be involved in our decision process. Motel cost is $150 a night in Florida, and when we're traveling down to Florida, it's going to cost us $100, and that would be if we're driving the car, obviously. Now, meal cost while traveling to and while in Florida are $40 a day, no matter whether we're in Florida or we're traveling. We just weigh. Our car insurance John's car insurance on his personal car is $100 a month. Kennel cost for his dog, so John apparently owns a dog, is $10 a day. That's a pretty cheap kennel. I wouldn't count on that dog being alive when he gets back. But the kennel cost is $10 a day. But at least the $10 is easy to compute when I have to multiply. Now, if John drives, the round trip cost of gasoline is going to be about $200. gas for the rental car, because when he brings a rental car back to the rental car company, he's going to have to bring it back with a full tank, and that's going to be $40. The combined cost of round trip airfare and rental car for a week, it could be $700 if he decides to fly down there and use a rental car. Driving to Florida requires an overnight stay between the two alternatives, and even more costs than that when we get down to this, but has assembled all the costs associated with um, his spring break trip to Florida. Now, John has to decide which of those costs are actually relevant in terms of doing a cost analysis of his trip to Florida. So now we take a look at the area of motel cost. And motel cost is $150 a night while he's in Florida when he's in Fort Lauderdale. When he's traveling to and from Florida, it's going to be at a less expensive hotel, $100 staying overnight when he's going down to, and then $100 a night when he's going from. So if I stay in Florida, if I decide to fly to Florida, I'm going to stay in the hotel for 7 days. So it'll be 7 days, and I'm going to put down 7 times $150 a night because I'm going to fly down and stay in the hotel for the 7 nights. So in this case, the total cost of flying would be $1,050. Now I'm going to write it up here because I'm going to need a little bit more room for this analysis. $1,050, that's the cost of the hotel if he flies. Okay, on the other hand, if he drives, and I'm going to use a different color just to keep things separate, if I can get the system to do that for me. And again, it's no small feat here with somebody who's not very good at this. Okay, so I'm going to use this additional font here to depict the blue font to depict now what happens if he drives. Okay, if I if I drive to Florida, I'm going to have 5 days in Florida, and that'll be the 5 days, if I can write it out, 5 days times $150 a day. That would be $750 a day when we do the calculation. Plus, I'm going to have 2 additional days, 1 day going down to Florida and a 1 day coming back. And that's going to be 2 nights, 2 overnights going and coming. So it'll be 2 days times the $100 because I'm staying at a less expensive hotel. So that's going to be a total of 2 times 100 will be 200. So when I add my total cost for traveling by car to Florida, my total cost is going to be $950. Now the question is, are these relevant costs? And remember, I have 2 alternatives. I can fly or I can drive. And relevant costs are those costs that differ between the alternatives. So in this case, these are relevant costs because they differ amongst the alternatives. So in this case, flying, the relevant cost would be $1,050, and driving, the relevant cost would be $950. Okay, let's go and we'll continue using this blue font right now for a while. Now, meals while traveling to and from Florida are $40 a day. Okay, so we have meals while traveling to and while in Florida, they're $40 a day. So that means when we travel to Florida, we pay $40 a day. When we're staying in Florida, we pay $40 a day. So we have 7 days that we have to account for. In other words, 1 day traveling to, 5 days in Florida, 1 day traveling from Florida, or if we fly, it would be just 7 nights or 7 days. So our food would be $40 times a total of 7 days. which would have a total cost of $280. Now notice here, as I mentioned, if I fly, the cost is $280. If I drive, the cost is still $280. And remember, a relevant cost are costs that differ between two alternatives. So in this case, the cost of everything, whether I fly or drive, is exactly the same. So the cost of food would be non-relevant in a decision process in terms of which is the most expensive or the least expensive, because I'm going to incur the same amount of cost. So those are not relevant costs, and those are not important to the decision process. Okay, the next item, so we've done meal costs now. The next item then it says is car insurance on his own personal car is $100 a month. So I'm going to put down, I'm just going to write as a notation car insurance, car INS for car insurance, and it's $100 a month, and I'll write down the cost here, $100 per month. And again, I would put this, if we're doing this as a live demonstration, it would be a little bit more detailed, but I'm doing the best I can with this crayon. Now the car insurance then, if I fly, the car insurance is $100 a month because I don't stop paying car insurance. If I drive, the car insurance is $100 a month. So in effect, if I say, is this a relevant cost that I need to analyze? And the answer would be no, because the cost of each alternative, flying or driving, is exactly the same. So in this case, car insurance would not be a relevant cost in my analysis. Okay, now what you can also see here is that the only relevant costs so far is the difference between flying and driving. The other cost I ignore. And one of the advantages of using this type of incremental analysis is that I only concentrate on the costs that differ between the two alternatives. The other cost I can ignore because they're not important to the decision process. This is pretty simple when you actually, when you have a simple problem like this. But if you have a complex business problem where there are all sorts of costs, it's easier to analyze a problem only if you identify the relevant cost and ignore the irrelevant cost in the decision process. So it does help considerably when you're going through that process. Okay, kennel cost for the dog. It's going to be $10 a day. Now that's basically, when you think about it, if he drives, it's going to be the kennel cost. I'll just put down KENNEL cost is going to be $10 a day times 7 days if he drives. So that's $70, and it also is $10 a day if he flies. So it's actually it's 70. The cost is $70. Whoops, sorry about that. Whether he drives or flies. So again, this cost doesn't differ between alternatives. So it doesn't matter whether, basically, it's not relevant as part of the decision process. Okay, now if John drives, the round trip cost of gasoline is going to be $200. Gas for the rental car is going to be $40. So I'm going to write here drive equals, that's DRIVE, it doesn't look like it necessarily, but if I drive, it's going to cost me $200. If I fly, the gas is going to cost me $40. So now again, I perform my analysis on relevant costs. Depending upon what decision I take, do I incur the same cost of both alternatives, or do I incur different costs? And I think you can obviously see here, if I drive, the cost is $200. And if I fly, the cost is going to be $40. So those are relevant to my decision-making process. Now the next element we encounter is it says the combined cost of our round trip airfare. Whoops, couldn't get the item to write. Let me try that again. The round trip airfare and the car rental for the week, the combined cost is $700. So if we fly, we're going to have a combined cost of $700. If we drive ourselves down, we're not going to need any rental car, nor are we going to need airfare. So in this case, if we drive, the cost of that rental car or flying is zero. So again, we take a look to these two costs, these two alternatives, depending upon what alternative I take, do they differ? And the answer is, of course, they do. In the case of driving, it's going to be zero. In the case of flying, that cost is going to be $700. Okay, now it also says driving to Florida requires an overnight stay, cutting John's time in Florida by 2 days. Okay, but the truth of the matter is there's no cost associated with that. It's just John's time. Also, by taking this trip, John will not be paid $120, which would have been earned from his part-time job if he stayed home. Now, what you could say is literally, okay, well, John, if he goes, he's foregoing, there is an opportunity cost of $120 in this case, because he's giving up $120 to take his trip. But there's a couple things to note here. Whether I fly or drive, I'm giving up the same cost. So as far as an opportunity cost goes, and that is his part-time job, and I'll put that down, part-time job of $120. He does give up the $120, but if he flies, he gives up that $120, or if he drives, he gives up that $120. So even though this is an opportunity cost, what that really means is that it's not relevant, because whatever alternative he takes between fly or drive, it's going to be the same thing. So again, that becomes not a relevant cost to the entire process. Okay, so now we've taken a look at all the costs. Now it's a matter of going ahead and analyzing the relevant costs. Okay, the first thing is that if John flies, his relevant cost of that decision include his $1,050, the $40 for the gas, and the $700 for the flying portion. So that comes out to the total is $1,790 basically relevant dollars to that decision. In the case of driving, we take the $950 plus the $200, and John's decision to drive means that the relevant costs associated with driving would be $1,150. Now you can see then, based upon this type of relevant cost analysis, the only relevant cost, in other words, where costs differ, are $1,790 versus $1,150. Now, I don't want you to get the impression that that's just the total cost of the trip. That's a relevant cost between making a decision between flying and driving. So if you were making a decision and you decided, well, I want to do the cheapest thing, well, the cheapest thing then was going to be, obviously, let me change my font here again, if I can do it, is obviously going to be the $1,150, because it's certainly cheaper than flying under the circumstances. But now we have some other, well, matter of fact, let's go on this real quick. So let's now move on to the quantitative analysis. We can look at this and say that it is, if we look at the difference between the two items here, and again, I'm trying to get my writer to write, and I apologize, the screen has shifted a little. I didn't have much choice here. But if I compare the two, what it shows is that it's actually $640 less expensive to drive than fly. Okay, so from a quantitative analysis, that means driving is $640 less expensive, EXP for expensive, and that's LESS for less right there, less expensive. Now, that doesn't mean you should take that. It's up to John to decide whether or not that is, whether the additional cost is worth it. Which brings us to, not only do we have to do a quantitative analysis, meaning quantitative meaning x greater than y greater than x, we also have to do a qualitative analysis. And what we have to say is, literally, John will receive an extra 2 days, and I'll put down extra, just abbreviating it, extra 2 days in Florida. And the question is, are those extra 2 days worth, again, are those extra 2 days worth the additional cost, the $640 of spending that, basically of the extra $640 of expense? And that's what we mean by qualitative, where we can't necessarily quantify the number in terms of John's desire, John's satisfaction. If John went through a terrible winter, John may consider those 2 extra days, the additional cost associated with those 2 extra days is, it doesn't matter to him. On the other hand, it could matter to him. It's in the eye of the beholder. The quantity certainly tells you what number is greater or less than another number. So now we can see, basically, analyzing relevant cost and analyzing them through a quantitative and a qualitative basis. Now that we have gone over relevant cost analysis, gone over an exercise, now we're going to get into an area called special orders. And how we basically use relevant costs in what we'd say special order analysis. Now, a special order, the definition of a special order for our purposes, it's a one-time order. In other words, we're only going to, we only have one opportunity to fulfill this order if we want to. So it's a one-time order that is not considered part of the company's normal ongoing business. So it's kind of like somebody comes in and they want to make a deal, a one-time deal with us, basically, and it's not one of our ongoing business customers, so to speak. So we need to consider again relevant costs, relevant costs and benefits, and that's going to include basically incremental benefits and our incremental costs. So let's take a look at the incremental benefits. The incremental benefits are the additional revenues that we're going to earn off of that special order. So if we're going to have a special order, our goal is to make money on that order, earn revenue. So the incremental benefits would be the additional revenues associated with that particular special order. Along with that, though, besides incremental benefits, we're going to incur incremental costs. Incremental costs in this case would be the additional costs associated with producing in effect that. Okay, now let's go ahead and take a look at incremental analysis for special orders. This is our example and our exercise. So the one thing, I apologize in advance because of the size of this slide and the limitations of the smartboard presentation and the video, we may have to jump around a little. Okay, first things first. We have a company and we take a look at their income statement, and we see the income statement shows a volume of sales of 100,000 units. And remember, whatever we sell, we produce. Whatever we produce, we sell. That particular rule is still in effect. So if we had 100,000 units and we sold $1 million worth of units, that must mean our selling price was $10 a unit. So that's how much we sold those units for. Okay, also, we take a look at the cost of our direct materials, and those cost us $350,000. So again, $350,000 of direct materials divided by 100,000 units equals $3.50 a unit. Okay, direct labor, $220,000 divided by our 100,000 unit volume means that our cost per unit would be $2.20. Factory overhead is $110,000, and we divide that by 100,000 units. The cost per unit comes out to $1.10 a unit. Also then, selling expenses, which are $140,000, we divide the $140,000 by 100,000 units. So that means the cost per unit of selling expenses is $1.40 per unit. And administrative expenses, which are $80,000, divide that by 100,000. The cost per unit in admin expenses is 80 cents. So if we add all the expenses together, they come out to $9 a unit. We sell them for $10 a unit, and the cost to make them is $9 a unit. So then we end up with a net profit of $1 a unit, or if you will, $1 times the 100,000 volume equals net income of $100,000. So everything works quite well. Now in our problem, we're going to assume our sales, our direct materials, our direct labor, and our overhead are all variable. So we're going to assume all those are variable costs. The remainder of our cost are fixed. So let's go down just for a minute here and take a look at this income statement. That again, this is the same income statement up here that I've reproduced down here. We start off with our $1 million of sales and end up with our net income. But as I mentioned, we now have to also think about cost behavior. Our direct materials, as I said, have a variable cost associated with them. And so the direct materials are variable, and we know the variable cost per unit is $3.50. We derive that by taking the 350,000 and divided by the 100,000. Direct labor is also considered V for variable, and the variable cost of each of those items are $2.20. And we also considered factory overhead in this case to be variable, and the variable cost associated with factory overhead is $1.10. So we have all our variable costs per volume in materials, labor, and overhead. We're also told, though, our selling expenses are fixed. So our selling expenses remain the same no matter what, so we don't have to worry about a cost per unit there. Administrative expenses are also fixed. We don't have to worry about the change there either. Okay, now we have some interesting cost behaviors here. Knowing that, the question is, a client comes to us, or a new customer comes to us and said, "I like to buy a large number of your products," and let's call them widgets. And that buyer offers to buy 10,000 units. That's, when you think about it, that's a pretty big number of units. That's 10% of our entire production. So this company is going to buy that from us, and they're going to use their own name. They don't want our name associated with the particular product. They're going to slap their own name on there. Now, the only problem is that normally we sell our unit. If you take a look at our selling price, we sell it at $10 a unit. That's what that's what we get from the market. But these guys are coming in and say, we will pay you only $8.50, but they're saying we're going to pay you $8.50 for a guaranteed volume of 10,000 units, which is 10% of our production. That's a significant amount of volume. So the question is can we afford to do that? Well, if you take a look at our total expenses based upon 100,000 units, our total cost to produce those units are $9 a unit. So the question is, if it cost us $9 a unit, does it make sense to sell them somebody an additional 10,000 units at $8.50 a unit? Now, initially your intuition will say, well, no, there's no way I want to do that because I don't want to lose money on a unit. But what we have to do is we have to perform an incremental analysis on this special order and say, incrementally, are we better off than we were if we didn't take this order? So again, it's going to be a decision amongst two alternatives, whether to take the order, or not to take the order. So let's start off again with example number one. So the company says, okay, we'll buy the 10,000 units at $8.50 a unit. So what I've done here under example one, I've created our sales price. It's $8.50 a unit. Now they're going to buy 10,000 units. So that means our incremental sales are going to increase by $85,000. Okay, however, we have to remember our cost may or may not increase depending upon how they behave. Our direct materials, which are variable, are going to increase on a variable basis, and the variable cost per unit of direct materials is $3.50. So $3.50 times 10,000 units in that incremental order means that our incremental cost would be $35,000 in direct materials. Okay, direct labor, same thing, variable cost, $2.20 per unit times 10,000 units means that our direct labor is going to be $22,000 incrementally for those 10,000 units. Factory overhead is also variable, and it's $1.10 per unit times 10,000 units equals $11,000. Now we take a look at our selling expenses. Our selling costs are fixed. So even if we decide to increase our volume by those 10,000 units, I'll put 10,000 V for volume right here, our fixed cost, our selling expenses, which are fixed, are not going to change at all. So whether I take the work, whether I accept the volume or don't accept the volume, it's still going to be the same in terms of incremental, basically, or in effect, my costs. So it's actually going to have no effect whatsoever on my order. So again, that will not be part of my incremental decision analysis. It's not a relevant cost. Administrative expenses are fixed. So whether I accept that order or not, they're still going to be $80,000. So again, those expenses are not relevant to an incremental analysis. So I ignore those, because whether or not I take the order, it's still $80,000. So now I do pretty much simple math, and it's going to be, I'll add up all my expenses here, which total to be 35 plus 22, 57 plus 11. That would be what, $68,000 total costs. So I take a look at the amount of incremental revenue I'm going to earn of 85,000. I compare that to the incremental costs that are going to be incurred as a result of that order, and it's going to be 68,000. So the difference is I have an incremental increase to my net income of $17,000. So if I accept that one-time order, I'm going to be $17,000 better off than I was if I didn't accept that order. Now, we're going to try example number 2, and I'm just going to use a different color on here, hopefully. Uh, yeah, it's purple or something to make sure I don't mess these numbers or cross these numbers up. Now let's assume we have exactly the same information as in example 1, where the company says we will buy 10,000 volume. So I'll put the 10,000 volume at $8.50 per unit. So we have some additional information here though. So us being the selling company, if the selling company accepts that offer of 10,000, for the duration of the order, total selling expenses will increase by $2,000. Why? We're just told that's what'll happen, so we just leave it at that. Total administrative expenses will increase by $1,000. So for some reason, our fixed costs are going to increase, excuse me, by an incremental amount. So if we assume under example 2, again, we would add $85,000 of revenue. We would have $35,000 of our expenses, direct materials, $22,000 of our direct labor, and $11,000 of our factory overhead. And the reason for that is all these particular items are variable: materials, labor, and overhead. Now we get to the fixed items. Now normally they wouldn't change, but in this case our total selling expenses, for whatever reason, are going to increase by $2,000. So we have an incremental change in selling expenses of $2,000. So we put that in our incremental analysis. So if we accept those 10,000 volume, for some reason our selling expenses will increase by another $2,000. Administrative expenses will increase by $1,000. So again, we'll basically show that incremental change of $1,000. Now we will go ahead and calculate our total costs. So in this case, our total costs are going to come up to a total of $71,000, which happens to be the addition of all these items right here. We compare that to our incremental analysis in terms of sales, and we can see that we are still going to be better off by accepting that one-time order of 85,000 versus 85,000 minus $71,000 of incremental cost. So we're going to be $14,000 better off, again, by measuring the incremental revenues against any incremental costs. This exercise, we're going to calculate our using incremental analysis. We're basically do contribution margin incremental analysis. And again, sorry about that, for our special orders. So in this case, a company is approached by a buyer that offers to buy 10,000 units. That sounds familiar, doesn't it? Okay, at $8.50 a unit. Again, familiar. If the selling company accepts the offer, total factory overhead will increase by $15,000. Now, what I am going to do to simplify this and make this problem basically carry over from the first problem, what I'm going to do is I'm going to eliminate one of the items here. If the selling company accepts the offer, those 10,000 units, $8.50, I say total factory overhead will increase by $15,000. Okay, in this case, I'm crossing all of that information out. That will have nothing to do with the problem, so we'll go on from there. It'll make life a little more, simplify life a little bit more for you in this learning process. However, if the company does accept the order, selling expenses will increase by $12,000 and total administrative expenses will increase by another $6,000. Now, assuming the company had an income statement that looked like this, and by the way, if we go ahead, we can basically take a look at that income statement, and it's going to be the exact same income statement we created right here. So I'm going to put that up here now again, $1 million in sales, and eventually everything ends up with a net income of $100,000. This is a traditional income statement. Now, what we're going to assume is that our sales are obviously variable. Our direct materials are variable like the previous example. Our direct labor is variable like the previous example, and so is our factory overhead. Our selling expenses and our administrative expenses are fixed costs. So now what we can do is we can reassemble this traditional income statement into a contribution margin income statement, and it's pretty simple since we have basically separated variable into fixed. Our sales are $1 million. Our variable costs then will be the addition of materials, labor, and overhead, which adds up to 350 plus 220, that's 570, plus 110, I believe that's 680. Let me confirm that. 570, 10B, 680. So our variable costs are $680,000. Okay, therefore, our sales minus our variable costs gives us a contribution margin of $320,000. Okay, now, interestingly enough, when we talk about contribution margin, our contribution margin is $320,000. That's the amount of sales revenue that's left over after we paid for our variable cost of producing and selling the good. And that is there now to cover our fixed costs and then contribute to net income. So our fixed costs in this case are a total of $140,000 plus $80,000, which comes up to $220,000. So I'll add our fixed cost in here, $220,000. And our net income then equals $100,000. So again, our contribution margin of $320,000 covers our fixed cost of $220,000, and then anything remaining after that covers our net income of $100,000. Now we're going to calculate the contribution margin using incremental analysis using our contribution margin. So the first thing is, again, the first step that we have to do is we have to calculate the contribution margin for the special order. Now, this really isn't that difficult. Again, remember our contribution margin is equal to our selling price minus our variable cost. That's the contribution margin. So in this case, our selling price will be $8.50. That's our selling price minus the variable cost to produce it. Now in this case, what we're going to have to do is we're going to add up all these variable costs and then divide them by the 100,000. So in this case, our variable costs were basically $680,000 divided by $100,000. So that means our variable cost to produce would be $6.80, which leaves us left over with $1.70 contribution margin per unit. So every time we sell a unit, we not only cover the cost of that unit, but we also, let me rewrite this number here, $1.70. So it's a little bit easier to see. We basically cover not only our variable cost, but we then have $1.70 to contribute to our fixed costs, and then eventually our net income after we've covered our fixed costs. So now what we want to do is we want to calculate the incremental contribution margin that is earned from the order. So in this case, we know what our contribution margin is, and it's going to be the $1.70 that we're going to earn from the order. So we take $1.70, which is our contribution margin for every unit. Okay, now we multiply that contribution margin times the amount of units, which would be 10,000 units. Which gives us a total incremental contribution margin of $17,000. So that's our incremental contribution margin. Now we have to understand, do we have any incremental increase in our fixed costs? So we take a look here again in our explanation of our problem, and it says our total selling expenses increased by 12,000, and our administrative expenses were going to increase by 6,000. So my selling expenses are going to increase by $12,000. Plus 6,000 increase in my administrative cost. And if we total those two together, they're obviously going to equal $18,000 in terms of total increases, incremental increases. So now I've got to go ahead and determine whether or not my contribution margin, my incremental increase in my contribution margin, is adequate to offset my increase in any fixed costs. And here what I show is my increase in my contribution margin is equal to $17,000, which I got from step number 2, the incremental increase in my contribution margin. From that, I subtract out any incremental increase in my fixed costs, in this case, which happened to be $18,000. And when I see the result is I end up with a negative $1,000, which means that I'm actually $1,000 worse off under this scenario when I am if I accept this particular order. So this is an example of what we call a incremental contribution margin calculation. Now let's take a look at another type of special order problem. And this is a company that is again, they need to understand whether they should accept a special order. So Visionary Game Company sells 500,000 units, game units per year of a video game, and they sell these game units at $35 each. Now the current cost of the game is broken down as follows. Direct materials, $5. Direct labor, $4. We also have, interestingly enough, two types of factory overhead. One that is variable and one that is fixed. So we have an overhead that varies with volume, and we also have an overhead that is fixed. So these are basically treated separately. So in this case, at the beginning of the current year, Visionary received a special order for 50,000 game units. Again, 10% of the total production for the year. But they were told that if they want to sell the 50,000 games, the selling price is going to have to be $13 a unit. Now, we also have to consider another issue here. To fill the order, Visionary must rent some additional assembly space at the cost of $15,000 for that 1 year it fulfills the game units. The question is then, under those circumstances, seeing our cost behavior and then these incremental costs too, should the company actually accept the order? So now we need to go back and calculate incremental benefits versus, incremental benefits versus incremental costs. Okay, we're right back there. That's where we should be. Okay, so we're going to start out with incremental benefits. If we're going to be able to sell 50,000 units, I'm going to try to write this in this space, 50,000 volume times $13 per unit. That's the 1-3 there, just so you know. The 50,000 units times the $13 sales price would be $650,000. So let me put in the incremental benefits from this sale. $650,000. Okay, now let's take a look at the incremental. Let's say, first of all, we're going to have to deal with incremental variable costs. So our incremental variable costs are actually pretty easy to calculate because we've already identified them. We know they're direct materials. Let me go ahead and mark these off. We know they're direct materials. We know they're direct labor. We know they're variable factory overhead. So if we add these three items together, it's going to come up to our total variable cost per unit is going to be $12 per unit. So every time we produce and sell a unit, we incur a variable cost of $12. So in this case, it's a matter of taking our 50,000 in volume times $12 variable cost per unit. That's a 1-2 right there, variable cost. So 50,000 times volume times $12, that means that the total incremental variable cost would be $600,000 that would cost the company. Now also, typically fixed costs remain the same as we know over volume, but in this case we are told Visionary must rent additional space. So the rental space, which is normally fixed, they're going to have to spend an additional $15,000 for 1 year. So we would also incur, in addition to our variable cost, an additional $15,000 as an incremental fixed cost. Sorry, again, I'm messing up with some of this stuff. $15,000 incremental fixed cost. So I'm sorry, and I also forgot a number here. Let me back up. My incremental contribution margin, which I should have calculated, would have been the total of the $50,000. Let me see if I can make that mark right there. I'll use a red number. What I should have put in here was the incremental contribution margin was actually $50,000. So we'll take that 15,000 out right there. Sorry about that. Now I go with the incremental fixed cost, which I'd mentioned again. Those were due to the fact that my $15,000 incremental fixed cost for the additional rent. So that'd be $15,000. Okay, now in doing the incremental, I keep messing up with this line here. One moment, please. Okay, so I take a look now at my net incremental analysis, and what it tells me is that when I subtract my incremental benefits from my incremental cost, which happened to be the $600,000 and the additional $15,000, I'm going to end up with a positive incremental benefit of $35,000. So in effect, $650,000 incremental revenue minus my incremental variable cost, that gave me an incremental contribution margin of $50,000. And that contribution margin is there to cover any incremental fixed cost plus then contribute to incremental net profit. So in this case, if Visionary had accepted that particular game order, $13 per game, Visionary would be better off by $35,000 if it accepted that order. Now let's do the Visionary game order again, but in this case we're going to use incremental contribution margin incremental analysis just to see how that works. So again, Visionary Game sells 500,000 units and the normal selling price is $35 each. The current cost of the game is broken down as follows. And again, this is the exact same cost from our previous slides. And again, if we want to add up the variable cost of producing each game, it's going to be the $5. Whoops, sorry about that. It's going to be the $5, the $4, the $3, and the $2. So those add up to, I'm sorry, the $5, the $4, and the $3. My bad on this other item. So 5, 4, and 3, which adds up again to a variable cost of $12 per unit, just so we have that information. So at the beginning of the year, the company receives a special order for 50,000 games at a sales price of $13 each, the exact same data from before. Now, again, Visionary must, in order to fulfill the order, Visionary is going to have to rent additional space. So that's going to be an incremental fixed cost for 1 year. The question is, should Visionary accept that particular order? And let me go back again. Okay, so should Visionary accept this particular order? So we're going to have to go through the Visionary calculations right here. Okay, the first thing we want to do is we want to calculate the contribution margin for the special order. And again, what we have to do is we have to take the $13 that Visionary had originally, or the $13 selling price that Visionary would have to accept to earn that order for 50,000 games. So that's our selling price. From that then, we subtract out the variable cost associated with this particular order. That happens to be $12. So now our variable cost is going to be $12 per unit, which means our contribution margin is going to be $1 per unit. Now, since we know our contribution margin is going to be $1 per unit, based upon the volume that the company is ordering, the $1 contribution margin times the 50,000 game volume, means that we're going to have a $50,000 incremental contribution margin for the year in total. We also have to consider the fact, though, besides that incremental contribution margin, that's going to have to cover any fixed costs and then add to net profit. So now we have to see, do we have any incremental fixed costs? And in this case, Visionary must rent additional assembly space at the cost of $15,000 for the year. So we have an increase of $15,000 in our fixed costs. I'll just put down $15,000. So our incremental increase in our contribution margin is $50,000, and we subtract out our incremental increase in our fixed cost of $15,000, and the difference between the two happens to be $35,000. So our incremental contribution margin exceeds our incremental fixed cost by $15,000. So that means we're better off by $35,000 if we accept the order. You'll also notice that by doing the contribution margin, the incremental analysis in this previous problem, we came out to the same exact number since all the data between these two problems are the same. We just arrived at the answer a bit differently. Okay, with that, that should be the end of our presentation for tonight, and I will see you uh, this coming Tuesday. Have a good weekend.